Microsoft is trading at 22 times forward earnings. Coca-Cola trades at 23. Just let that sit for a second. The company that basically controls the cloud for half the Fortune 500, that owns a huge stake in OpenAI, that just launched a chip that outperforms Amazon's by 3 times, is being priced by the market at a lower multiple than a company that sells soda. It's priced right alongside the entire S&P 500 index. Something here just doesn't add up.
Either the market is right and Microsoft is in some very serious trouble, or the market has made a very, very expensive mistake. There really is no middle ground when the numbers are this far apart. And right now, the story the market is telling itself, the one that's driving this valuation, is a story of fear.
You've probably heard it. Everyone covering Microsoft right now is talking about the software apocalypse. It's a really compelling and kind of terrifying narrative. The idea is that these new AI agents will just operate our software for us, completely wiping out the need for the per-seat subscription model. The entire foundation of Microsoft 365. It's the ultimate bear case. The idea that Microsoft's biggest cash cow is about to get retired.
But here's the thing. That narrative, it's wrong. It's factually backwards. The data we have shows that AI agents aren't the enemy at all. In fact, they are shaping up to be Microsoft's single best customer. And by the end of this explainer, you're going to understand exactly why. We are going to dismantle that software apocalypse thesis piece by piece. We'll look at what Azure's supposed slowdown really means, uncover the secret weapon that could totally change their margin picture, and follow the math to see just how big this disconnect really is.
Okay, so let's get right into it. A valuation that defies logic. Look, it all starts here with the numbers, because they're the first clue that something is being deeply misunderstood. A company's PE multiple is just the market's report card on its future. High PE, high expectations. Low PE, low expectations. So what does a PE of 22, the same as the broad market average, tell us about what the market expects from Microsoft? It's expecting them to be completely average. But then you look at the actual results, and that idea of average just falls apart. You've got revenue growing at 17% year over year, net income's growing even faster at 24%, and their flagship AI product, M365 Copilot, paid seats have exploded by 160%. Come on, these are not the numbers of some boring average company. These are the metrics of a business that is absolutely firing on all cylinders right at the heart of the biggest tech shift in a generation.
And this gets to the heart of the whole misinterpretation. The market is pricing Microsoft as if the AI transition is happening to it, like it's a legacy company that's about to get run over. Think of a taxi driver seeing the first Uber on the street. But all the data we have suggests the exact opposite. The AI transition is happening through Microsoft. They're the pavement, they're the cell towers, they're the charging stations, and those are two fundamentally different things to invest in.
And if you look at the chart, the stock is at a really interesting spot. It's sitting right around its 200-week moving average. Now, for a name like Microsoft, this is a pretty rare event. It's a line in the sand that has only been touched twice before in recent history. And both times, what happened next was a rebound of about 15% over the following month. It's a sign that the price might be finding a floor. But before we get deeper into the price, we have to understand what we're actually buying. And that means we have to start with the bear case, because that's where this whole story gets really interesting.
So let's talk about it. The myth of the apocalypse. To really see the opportunity here, you have to get inside the fear. It's the main thing holding this stock back. So let's be fair and lay out the bear case properly.
So, the argument goes something like this. AI agents are getting so good they can operate software on their own. So why would a company pay for a Microsoft 365 seat for a person if an AI can just call an API to do the work? And if that happens, the whole per-seat subscription model, which has made Microsoft so much money, just collapses. And you know what? It's a logical fear, but it completely misses what's actually happening. The reality is that these agents aren't replacing users. They are becoming super users, and they're making the platform more essential than ever. And we don't even have to guess about this. We have the data. Right now, there are 15 million paid seats for Microsoft 365 Copilot. Let me say that again. 15 million. These are big companies paying more money, not less, to plug AI right into their existing Microsoft workflows. They are not canceling subscriptions. They are paying a premium to arm their employees with better tools. The apocalypse isn't happening. In fact, the complete opposite is.
There are 3 really solid reasons for this. First, Microsoft has this incredible data moat. You can call it their work IQ. It's all the decades of company data living inside M365, the org charts, the emails, the meeting histories. No AI agent can do its job without that context, and only Microsoft has it. That, in turn, makes Microsoft the central hub. It doesn't matter if it's Claude or some open source agent. To do real work, it has to plug into Microsoft's data. And finally, these agents are driving engagement through the roof. We're seeing user conversations and engagement intensity basically double. People are using the software more, not less, which just reinforces Microsoft's power to set prices.
Okay, so if the SaaS apocalypse isn't happening, what about the other big worry? You know, the one about Azure's growth slowing down. The market got pretty spooked by it. But stick with me here, because what looks like a problem on the surface is actually a sign of some incredibly smart, strategic thinking. And again, we don't have to guess. The answer comes straight from the CFO Amy Hood. She said it flat out on an earnings call, this slowdown is a choice. It is not a problem with demand. She said if they just gave all their available GPUs to their third-party Azure customers, that growth rate would be over 40%. So the real question is, why on earth would they intentionally slow down their flagship growth engine? The answer is this really smart strategy called compute arbitrage. See, in a world where powerful GPUs are scarce and super expensive, not all revenue is the same. Selling raw cloud compute to an outside customer has one margin, but using that same precious compute to power your own high-value product, like M365 Copilot, well, that generates a much, much higher long-term value. So Microsoft is choosing to let the headline Azure growth number dip a little so they can squeeze the absolute maximum value out of every chip they own. That's not weakness, that's just smart business.
And this whole strategy is backed by a massive $625 billion in what's called remaining performance obligations, or RPO. Just think of it as future revenue that's already signed and in the books. Now, it's true, a big chunk of that, about 45%, is from OpenAI. And that's a fair concern about concentration risk. But here's the other side of that coin. That contract is basically OpenAI prepaying for its server time all the way through 2032. It gives Microsoft guaranteed cash to build out all its data centers and chips. And get this, even if you take OpenAI out of the equation completely, the rest of that backlog still grew at a super healthy 28%. The demand is broad.
And this leads us right to the next piece of the puzzle, the in-house margin engine. If you want to be the world's AI supercomputer, you have one giant problem, the insane cost of chips. The number one thing killing margins in AI is how much NVIDIA charges for its GPUs. Microsoft's answer isn't just to buy more chips, it's to build their own. So, meet Microsoft's secret weapon, the Maya 200 chip. And this thing is a beast. It's delivering over 10 petaflops of performance, which is 3 times faster than what Amazon has with their in-house chip. But more importantly, it gives them a total cost of ownership that's 30% lower than buying from NVIDIA. Now here's the key. They don't need to beat NVIDIA in the open market. They just need Maya to handle their own massive internal workloads, like all those queries from 15 million Copilot users. By running that traffic on their own cheaper silicon, they can bring their margins right back to where they were before the AI boom. But the hardware is only half of it. The other half is the software platform they're building on top. They recently changed the name of Azure AI Foundry to just Microsoft Foundry. Dropping the Azure from the name is a huge strategic signal. They're positioning this thing to be the foundational platform for the entire AI industry. The best way to think about it? They're trying to become the TSMC of AI.
The strategy is actually brilliant. Step 1, get every important AI model on the planet onto your platform. They already have over 11,000. Step 2, become the one-stop shop that every developer uses to deploy and manage those models. And step 3, collect rent. Microsoft doesn't need to pick the winner in the AI model wars. Just like TSMC doesn't care if Apple or NVIDIA sells more chips, Microsoft gets paid no matter what. Every new model on their platform is just another tenant paying them rent.
And this whole platform strategy helps explain one of their most confusing recent moves, the partnership with Anthropic. See, Anthropic is a direct competitor to OpenAI, which Microsoft has a massive investment in. So why on earth would they let the enemy inside the gates? Why would you embed your competitor's products right into your own platform? Well, it's a power move with multiple layers. First, it brings Anthropic's best-in-class AI agents, the very thing the bears are afraid of, right into Microsoft's world, but under their control. Second, for Anthropic's agent to do anything useful, it has to tap into Microsoft's Work IQ data, which just makes Microsoft's data moat even deeper. Third, it means they're not totally dependent on OpenAI anymore, which gives them huge leverage. And fourth, and this is the most important part, it reinforces who's really in charge, the one who controls the compute. It doesn't matter which model wins the race if they both have to run on Microsoft servers. So let's bring it all back home, back to where we started, the valuation. We have taken apart the software apocalypse myth. We've seen that the Azure slowdown is actually a strategic choice.
We understand how their own chips and platform strategy are designed to protect their margins. So now we can look at that price again with a completely new set of eyes and ask, where does the math actually lead?
The way I see it, this is an asymmetric bet with some very clear catalysts on the horizon that could force the market to wake up. First, they've already announced a 33% price hike on some M365 plans coming in July 2026. That's pure profit. Second, as that Maya 200 chip really starts to scale up in fiscal 27, that margin pressure from expensive GPUs is going to ease up. And third, down the road, you have this new Agent 365 platform, which is a whole new way for them to make money, charging fees to manage agents.
So it really all comes down to this. The market is pricing in all of the risks of this AI shift, the disruption, the margin hits, the competition, without pricing in any of the massive upside if they pull it off. It's failing to see what Microsoft becomes if this all works. They're not just a company that sells Office anymore. They're becoming the fundamental control layer for all of global AI, and at a valuation cheaper than a soda company. The disconnect between the story and the numbers has rarely been this wide. Markets reward the people who do the work before the crowd shows up. You just did the work. See you in the next one.